investors are focused on revenue generating projects that have improved fundamentals that have been around for some time. The risk reward has improved a lot after this flash crash. The key is being very selective and focusing on quality rather than just, hoping that we are going to have a broad-based altcoin rally, which in my view is never going to happen. The market is separating winners from losers, I would say, much more clearly now than it was during the euphoria phase and everybody was blindsided to some fundamental realities of certain investment opportunities.
Hello guys, this is Ed and very welcome to our Crypto Insight, provided to you by Venionaire Capital, the entrepreneurial partner for venture capital and private equity, and of course DLT Austria, the non-profit association for education in the crypto space. Today, me and Igor, the investment director and portfolio manager of the Venionaire Web3 Fund. Hi Igor.
Hi Ed, thank you for having me. Looking forward to discussing a couple of topics with you. It's been 2 months since our last recording, so let's dive into it.
Yeah, it's a pleasure. Let's start. Igor, this episode comes at a very different moment.
Yes.
Then our last conversation early October, when Bitcoin had just hit a new all-time high.
Exactly, yeah.
Highs above 125,000 US dollar.
Yeah.
The market has undergone a significant correction. Can you set the stage for what's happened over the past 2 months?
Oh, well, a lot has happened over the past 2 months. It's been a challenging period, I would say. Bitcoin and Ether have essentially erased all their gains for the year. We had a sharp turn for a market that watched Bitcoin just hit that new all-time high just around 125,000 US dollars, like 2 months ago. And the broader picture looks similar. We have total 2 and total 3 are down 30-35%. During the last week, Bitcoin recovered to roughly 93,000 US dollars, let's say, region, but managed to close the last month, the month of November, near its yearly open. Yesterday, 1st of December, we had another sell-off hit Bitcoin, so it is now negative year to date at this point.
That's really a dramatic shift from where we were. What do you think are the main factors behind these corrections?
Well, there are a couple of factors, but maybe for just to highlight 2 key points for me or from my perspective. First, the October 10th liquidation event that we've seen was the biggest one in the crypto history. So it was an outlier event as per definition. So it was driven by a mix of different factors like low liquidity, let's say poor risk management, a leverage mechanism design. There were also some technology or tech correlations within the entire system, let's say. Also weak Oracle and price feeds, non-working price feeds as well. So the flash crash was let's say it is an extensive standalone topic. It caused significant losses, structural damage, and also introduced a lot of uncertainty into the market. This was essentially a leverage washout, which cascaded through the rest of the market, but it was in combination with technology in part breaking down and in part with withdrawal of market makers. So there was both, let's say, assets correlation and operational or technological correlation going to one. Second part was that the macro environment has turned, I would say, less supportive. Expectations for near-term rate cuts in the United States have faded, but then bounced back pretty sharply. U.S. inflation remains, I would say, sticky and elevated. U.S. job markets have also weakened. So there are some geopolitical risks that have increased. So consumers are also generally showing, let's say, stress when it comes to spending, and investors are more cautious when it comes to investing. So the combination of all of these things has pushed most risk assets to trade, let's say, poorly over the past 2 months.
You mentioned the October flash crash. How was that event in terms of Bitcoin market structure?
Bitcoin specifically, I mean, it was very significant. From 123,000 US dollars down to, let's say, 100 to 105,000 US dollars. This was quite the range, depending on the centralized exchanges or the trading venues in general. So it is quite a, let's say, a jump down from higher prices. But in the following weeks, since the October 10th flash crash, let's say a low to mid 80,000 region for Bitcoin absorbed this sell pressure, specifically mostly the area between, let's say, 83,000 and 86,000, which currently still holds. If I'm not mistaken, today's Bitcoin price is around 86.5, 87,000. So this is now area that shows, let's say, fresh accumulation and strengthens this area to act as a solid support, which initially formed as a result of that flash crash. So the price region has been retested, I would say, a bit too fast, too quickly for my liking. It must hold. The loss of 80,000 for Bitcoin would open doors for, let's say, retesting of much lower prices, initially mid 70K, even reaching a low 70K area. So what we saw with that crash is that order books were thinner, and especially altcoin books got emptied out, which of course has implications for how long the recovery process might take.
Okay, thanks, Igor. So let's dive deeper into Bitcoin's current technical picture and what levels matter most from here.
I think Bitcoin is at a critical point, critical juncture right now. The aforementioned 86,000 region must hold as support. Usually periods around the end and start of the end of the month and start of the next month, start of the new month, bring increased volatility, which settles during the first week of the new month. This is also the case, usually the case in TradFi markets. So right after November's monthly close and during the first trading hours in Asia, Bitcoin had a sell-off that was triggered by bearish developments across Asian markets. So maybe I'll get to those points, macro factors, in a moment. But technically, if we lose 80,000 as price level on higher time frames, daily, weekly, I think we are looking at potential retests of mid 70K or even lower areas.
The ETF flows have been interesting during this correction. Can you walk through what institutional investors are doing right now?
I mean, Bitcoin ETF owners did not panic sell during market fluctuation, during this high volatility period. So the ETF structure protected them from forced selling, from liquidations, automated or automatic deleveraging mechanisms, and generally protected them from failures and risks of centralized exchanges, decentralized exchanges in general. So spot ETF holders survived this storm with just some bruises due to volatility. So in the last week of November, spot Bitcoin ETFs in the United States saw minor positive net flows of some 70 million US dollars. But had over $460 million in inflows in general. So this plus 70 million net inflows I think its significance is greater than the number itself suggests, because this broke a string of 3 prior weeks where we have had heavy net outflows, which totaled about 3.5 billion for November as month as a whole. With and finished the month of November with 120 billion assets under management. So I'm stating this just to put things into perspective. About 3.5 billion out of, let's say, 100 billion assets under management is 3.5% outflows. So it is not like end of the world. And this 70 million plus net flows is just a first signal for me that there is a positive shift in sentiment, especially after a Fed key member raised hopes for another rate cut in December. So the expectations have, I would say, strongly rebounded. Market was pricing in market was expecting the Fed rate cuts with probability around 30%, and then we jumped 2 days afterwards, jumped back to 85%, which is in a way a signal of positive shift in sentiment.
So you mean the outflows reflected profit taking rather than a fundamental loss or confidence?
That's well said. Exactly. I mean, the spot Bitcoin ETF outflows, they also reflect institutional profit taking. You have, after Bitcoin's rally and all-time highs. And this is also due to year-end portfolio rebalancing. I mean, it's not a fundamental loss of their conviction. Spot only ETF, approach with having spot only ETFs was, in my view, validated. And this comes with, of course, some risk-adjusted rebalancing, which is also justified for institutional investors. I mean, unlike retail investors, the institutional investors have very strict internal, external rules to follow. They have compliance, they have reporting, KPIs, etc. So it's not as simple as it is the case for let's say your average Joe trader who puts in $1,000 or $2,000 to buy Bitcoin. Cumulative ETF inflows remain positive, and this is a very good thing. And Bitcoin futures open interest, for example, is continuing to rise, which confirms that institutions are still structurally long, but they're now more sensitive to valuations because of the macro uncertainty. Globally, ETF and ETP products rebounded strongly with over 1 billion in inflows in the last week of November. And as of today, VanEck, which is the second largest asset manager on the planet with $11 trillion US, starts to offer ETP and ETF, crypto ETF products to their clients on their brokerage platform, which means now the conservative capital, such as retirement funds or retirement accounts in the United States, have access to digital assets, which also in of itself is a very positive. Maybe as a side note, interesting development after we have seen the biggest flush in crypto history.
So there's been a lot of discussion about lack of fresh demand. What's your view on the current demand pictures?
Yeah, I mean that's a valid point. That is one of the challenges. That's still one of the challenges. Outside of tokens that are supported by, for example, buybacks, broader crypto market has seen very little incremental spot inflows, except maybe in digital assets, treasury companies. So new demand remains, let's say, thin. But you have at the same time very, very high dispersion of coins and tokens, generally altcoin market. And you also have more and more perpetual trading products or platforms offering such products, the ease of access to perpetuals trading makes it a bit, let's say, challenging. Spot markets and ETF flows do not longer provide the major support like they did in the early years, where you only or mainly had access to spot markets. And this results in many altcoins prices have just fallen much faster and easier during outlier events such as we've had with this flash crash on October 10th. So it's important to know that ETFs and DAT companies are just one part or group of market participants, but they had been a significant driver when it comes to rallies behind certain assets, for example, Bitcoin or Ether or Solana. So their weakening buy pressure is felt across the market.
Okay, and what about forced sellers? Are we mostly through that, or is there still more deleveraging to come?
Well, after the flash crash, we've had a couple of heavy leveraging, let's say, washouts, but nothing as what we've had on the 10th of October. So there is always going to be a certain deleveraging, let's say, event to a certain degree. For example, Bitcoin has bounced off of its lows around $80,000, and ETF flows have shown small signs of improvement, as I've just mentioned, which to me suggests that the forced seller or forced sellers might be mostly out of the game. However, the conditions that we have right now remain choppy and wonky. Markets are still reacting to each new data point, for example, on rates or on inflation, maybe some political statements, and even AI earnings. So there's still this sensitivity to which data is published, which news is now a major headline, and markets react to that. So this looks more to me like early cautious stabilization phase attempt than the start of a clean rebound. The psychological price level for Bitcoin is 100,000, and the range between 100,000 and 115,000, let's say like a local range. This has emerged as the key zone, in my view, the key zone for a sentiment shift, for a clear, strong shift in sentiment, and also for positioning. So reclaiming and holding that band, let's say, would suggest market has moved from this fear or narrative, we topped, it's over, back to this, it was just a healthy reset before we make the new next leg up higher. So until this happens, until we are back in this range 100, 115,000 for Bitcoin, I think fear and caution are going to remain dominant mood. And I think the market is likely to stay very, very, very sensitive to any shocks.
What would be the clearest signal of sustained recovery of Bitcoin?
The clearest signal would be, I would say, stability in both flows and positioning, with price recovering. On a higher time frame like daily and weekly, 85,000 range where we are feeling right now. In my view, this has to hold. This must hold. We would need to see, of course, ideally a few weeks of very steady net inflows into spot Bitcoin and Ether ETFs, alongside derivatives data, maybe showing that open interest is being rebuilt. There is no excessive leverage in the system. There is no excessive unstable speculative capital, because unstable speculative capital is actually not supportive of spot prices, because it just focuses on short-term perpetuals trading with high leverage. So reclaiming and holding 95,000 for Bitcoin would be a first signal to me that October-November lows are actually in, that positioning has reset in a very constructive manner. For me, it would be a sign that the market has stabilized sufficiently to have regained confidence to try the new next to try the next leg up higher.
Let's turn to Ethereum and the broader altcoin market. The correction seems to have hit these assets even harder than Bitcoin.
Yes,
Isn't it?
yes, I agree. I mean, Ethereum and altcoins have taken a more severe hit than Bitcoin. I mean, Bitcoin has fundamentally different capital base and different capital infrastructure robustness than, for example, many of altcoins, maybe even 99% of altcoins out there. So Bitcoin liquidity, for example, held comparatively very well during the crash. Bitcoin spot markets functioned comparatively very well to, for example, altcoin markets. Many altcoin markets are completely broke, were not functioning. So talking about Ether, ETH ETFs, spot ETH ETFs had their largest monthly outflows with about some, if I'm not mistaken, 1.4 billion for November, while having at the end of the month of November 19 something billion assets under management. So it's not end of the world, but it is, let's say, sensible difference. However, ETFs, ETH ETFs have also finished the last week of November, similarly like Bitcoin, with positive net flows. With Ether, it was over 300 million, and Bitcoin was around 70 million, as mentioned. So similar to Bitcoin ETFs, we are seeing also with the spot Ether ETFs, let's say, the first signal of a positive shift, which I personally I like it. It's not going to save the day, but it's a first step in the right direction. So in total, both Bitcoin and Ether are giving early signals that sentiment may be bottoming and that we are slowly turning the boat around.
What do you think are the key technical levels of or for Ethereum?
Currently, what I have still in mind from today in the morning, Ether is trading on the weekly value area high of the past 4 years. So if you take a look at the past 4 years, on the weekly level value area high is currently where we are sitting at. So if Ether cannot hold that level, I think 2.4, 2.6K as a range are next. The local range of 2.5, 2.8 thousand Ether on a weekly basis has been actually pivotal. And this level is pivotal because it has given us quite a few, let's say, bounces. But right now we have seen only mild and short-lived bounces, which is for me a bit worrying. But as I've said, it takes time for the prices to gain foot and just to stabilize a little bit. And this is the level where we are currently at. So constructive price action for recovery for Ether, in my view, starts with 3.1K. At least 3,000 level has to be reclaimed and held. And if Ether is bullish in the short term, it really has no business trading below 2.5 thousand for any prolonged periods. I mean, this excludes quick intraday stabs that then print long wicks. So it's like an intraday, let's say, slippery or washout play. And then we are back back again in the next, let's say, 48 hours. So ideally, Ether holds 2.7K as a support, and then we start rebuilding towards 3 and 3.1K.
And how are altcoins positioned relative to Bitcoin?
Well, I mentioned already that total 2 and total 3 are down 35%. So Bitcoin dominance is, what's the word, tethering at its resistance area around 59-60%. And I would like to see a breakdown of Bitcoin dominance toward 58% as a first sign of altcoin strength. Given the flash out that we've had, and empty order books after the October crash, altcoin recovery is likely to take much, much longer than many people would like or hope for. I think it's just not realistic to see a faster recovery in many altcoins, with maybe exception of some majors. The new spot altcoin ETFs, like Ripple, Hedera, Litecoin, Solana, and many others that are in the pipeline, they have attracted so far modest inflows. Not really something to write home about, but it still highlights this institutional capital remains, let's say, firmly concentrated and focused in Bitcoin and Ethereum until greater maybe regulatory clarity or exchanges and on-chain stability emerge, because infrastructure-wise, on-chain, off-chain exchanges have shown quite a few weak points during that flash crash, which is also in part the reason why it got amplified. So having all of that regulatory clarity and exchanges or infrastructure improving would help with new spot inflows for altcoins.
So I heard a lot that they are thinking new altcoin ETFs haven't been the game changer some expected.
Yes,
What do you think?
that's a good observation. Yes, unfortunately, altcoin ETFs are a great start in supporting recovery, but they are only relevant to the altcoins that either already got their ETFs approved or are about to get them. So even that, I would say, is in of itself insufficient for very speedy rebuilding of demand structure and empty order books. There is an interesting dynamic happening. For example, the sell-off has reset the valuations for almost all fundamentally very strong altcoins or projects that are also revenue-generating projects. It has reset their valuation back to 2023 or 2024 levels, which means even as fundamentals of said projects have improved since 2023 or 2024, like, for example, on-chain activity or user growth or fees, their price they're now repriced. The prices are much, much lower. So Bitcoin dominance didn't, for example, spike in a sustainable way during the correction, which is usually a sign that there is still some appetite, still some interest for quality altcoins among those, or for those who know what they're looking for and where to find it.
The most important question is, are there any opportunities in this reset
Well,
for selective investors?
I think so. Yes, I think so. I hinted at it maybe in my last answer. I really genuinely think so, that investors who are focused on revenue generating projects that have improved fundamentals, that have been around for some time, I think for said projects the risk reward has improved a lot after this flash crash. the key is being very selective and focusing on quality rather than just hoping that we are going to have a broad-based altcoin rally, which in my view is never going to happen. There is no altcoin season anymore. So the market is separating winners from losers, I would say, much more clearly now than it was during the euphoria phase where a lot of coins were rallying and everybody was maybe, how do you say it, blindsided to some fundamental realities of certain investment opportunities.
Okay, let's shift to the macro picture. What are the most important catalysts you are watching over the next few months?
I would say macro clarity, the most important catalyst in my view is macro clarity, especially around interest rates and the Federal Reserve, talking about United States macroeconomics. The path of Fed rate cuts is perhaps the biggest driver for risk assets right now. Markets are pricing in future cuts, but there is still uncertainty about how much and how fast. We have the Fed rate cut decision, I think, on 10th of December, which is next week. So this will be critical, or it will be maybe a nothing burger event, meaning we get a Fed rate cut, but much less, to a lesser extent than markets had maybe anticipated. So the expectations have rebounded from some 30% back to over 85% within few days, which is remarkable and but also very volatile. And this probability for a cut, should it materialize, I think it's very supportive for risk-on assets, at least when it comes to U.S. equities and crypto markets.
Igor, how does Fed leadership factor in this that?
The U.S. Fed, who will lead the Fed in the next term, I think, is another major, how do you call it, variable, because currently the Fed chair, Jerome Powell, his mandate ends in May next year. So there is a pro-crypto candidate, one of candidates for the next Fed chair. And this pro-crypto candidate has, let's say, good chances. So expectations are that it would be very constructive for digital assets general over the next few years. So more broadly, the new Fed, with the new Fed chair heading it, I think with if they would then provide clearer signals on inflation, consumer spending, credit markets, job market data, overall liquidity conditions, I think, then it would strengthen the setup for Bitcoin strength recovering, which sometimes trades like a macro asset due to let's say, high concentration of investors coming from the United States, which makes it very sensitive to any macro developments in the United States.
You mentioned earlier that there has been a data blackout. So how is that affecting market dynamics?
Yes, given the recent the data blackout has to do with the recent U.S. government shutdown, which was the longest one in the United States history, and investors have been flying blind, so to speak. There were no macro key data that were analyzed, collected, published. And this has made trading and investing more volatile because markets have uncertainty. Markets hate uncertainty and have not really had any anchor point. So the October job openings, for example, that report is officially canceled, has been officially canceled, will never be published, which, will never be released. And this is the major labor data point before the next FOMC meeting, because the Fed always says they have dual mandate, and one of them is a strong economy meeting, resilient job markets. So it leaves markets to move on uncertainty rather than factual information. The next jobs report for November, I think, will matter more than usual because we skipped October and there is a gap in providing key economic data. And this report is set to be released on 16th of December, which is like 1 week after the next FOMC meeting on 10th of December. So the data that they say they need to make rate cuts decisions is being only published like 1 week afterwards. It's made available 1 week after the decision. So alternative data in the meantime is used and shows that U.S. layoffs are actually increasing. So, watching for labor market signals, I think, is and remains crucial.
And what about the positive macro factors? You mentioned U.S. fundamentals remain constructive.
Yes, in my view, yes, because U.S. Fed's quantitative tightening has officially ended yesterday on December 1st, if I'm not mistaken. And rate cut expectations, as I've mentioned, are back above 85%. So, we have a pro crypto candidate for the position of the Fed chair, has good chances. So along with regulatory policy in this sense, U.S. fundamentals remain constructive, in my view, for digital assets, given also that the current administration stated a number of times they want to have the leading role worldwide when it comes to digital assets in general. So the challenge is that global macro and geopolitical developments are supporting perhaps a buildup of bearish sentiment in the short term, and this can or would override the positive factors that are US based.
There's also been a discussion about how the AI trade affects crypto. So can you explain that connections?
That's an interesting connection. I mean, AI companies have become a core driver of risk appetite across emerging technology sector in the United States. So the two are these two are connected through, let's say, shared macro channels. If the AI trade strengthens, it somewhat supports crypto. If it weakens, the pullback will almost certainly spill into digital assets, meaning it's going to draw or drag digital assets down. The concern is that if AI infrastructure starts showing, let's say, deeper weaknesses, that can shock equities, but as well, both equities, CS equities, but also alternative investments, which is actually where digital assets belong to as a category. So, AI, especially with things like data center buildings or AI company earnings, crypto markets get impacted through, I would say, second order effects, like, weaker macro in public tech equities, and crypto is correlated to tech equities. So if there is a weakness with maybe sources of energy for AI data centers, or too much or too fast build-outs of AI data centers that cannot be as quickly as utilized, that would be a sort of a weakness that would affect also crypto or digital assets.
Okay, Igor, then let's move to another topic. So you mentioned geopolitical developments are creating bearish sentiment. Let's unpack what's happening globally, particularly in Asia.
Well, the sell-off that Bitcoin experienced over the past 2 days on November monthly close, which is Sunday, and yesterday on Monday, was triggered actually by I would say, very bearish developments across Asian markets. Japan's central bank governor has announced or communicated that his intention to increase rates, meaning rate hikes. And this was all very quickly reflected in, for example, Japanese 2-year bond yields, which rose initially to 1% and then later above 1%. This makes essentially borrowing in yen more expensive. So the increase or likely increase in rates in Japan already resulted in a surge of bond yields, of government bond yields for 5, 10, 30, 40 years durations. So which is a bit of a complex problem because this is a territory no policymaker have ever navigated in Japan. And one of the effects of strengthening of yen, for example, against US dollar, is that it sparks a risk of moves and impacts assets as, for example, Bitcoin. It is a major caution signal. It has not come yet to, let's say, fruition, but the markets are already reacting in a negative way, which could be very bad for Bitcoin.
And why does this matter so much for global markets in crypto?
As I mentioned, this is a bit nuanced or multi-layered development. It is very important to understand how this correlates to markets. For many years, Japan was, I would say, world's main source of zero interest rates or near zero interest rates. So zero cost to borrow Japanese yen. So this made Japan the world's silent source of liquidity of money. So when the Japanese, for example, 2-year bond yield goes up to 1% from near zero, it is a clear sign that this long-standing practice or mechanism is changing. This undermines and can or actually weakens the yen carry trade, where cheap loans in yen, because of zero rates or near zero rates, you have very cheap loans that are taken in yen, but they are invested abroad for higher returns. And for example, this is the case with much of investments in US equities. You borrow very cheap a loan in Japanese yen, but you invest that money outside of Japanese economy. So once yen loan rates now increase, which makes higher costs of existing debts and loans, higher costs for servicing and repayment of said loans, there is an unwind or reduction of investments that were made with such borrowed money, which results in sell-offs. So it pulls, in a way, the liquidity from foreign markets from abroad and brings that money, in a way, back to, Japanese economy. But this also negatively affects crypto because crypto is a risk-on asset. So this results in some sell pressure that is expected to spread over TradFi markets and also crypto markets.
We also have the Bank of Japan rate decision coming up later this month.
Exactly. Yes, exactly. So you have on December 19th, the Bank of Japan is going to announce their rate decision, which will be another critical date to watch, and combine with the Fed decision that is set for 10th of December next week. These two central bank meetings will likely set the tone for year end, and I would say also for early first quarter of the next year.
And beyond Japan, what other geopolitical situations are you monitoring?
We have two developing stories right now that are relevant for both traditional finance and crypto assets. First, we have Venezuela. U.S. operations are seemingly about drug enforcement, but are also at the same time transparently about oil, as was repeatedly publicly stated by members of current U.S. administration. So Venezuela holds 19% of global proven reserves for oil and 75% of natural gas reserves for the region's South America. So military escalation would, in my view, disrupt oil supplies. Currently, 80% of Venezuela's oil production is exported to China. And we already have tensions between the United States and China based on the tariffs policies and some other things. So which would essentially trigger a risk of across all assets. And then you would also have energy-driven inflation, which would pressure both traditional finance and crypto assets because risk on would be then avoided by investors.
And the second situation?
The second situation is Japan-China tensions. Japan's new prime minister, she announced deployment of missiles around 100 kilometers away from Taiwan, on a set of few smaller Japanese islands, which Chinese interpret as a sign of, as a form of provocation, which triggered Chinese diplomatic and also economic, retaliation that could cause Tokyo alone as a city around 14-15 billion annually due to tourism, for example. So this disrupts capital flows between the world's second and third largest economies, which creates volatility in currencies, in equities, and Asian capital flows that would or are flowing into crypto. This would be also disrupted. So I mean, Ukraine situation with Ukraine is already, in my view, priced in because it is a known issue, has been around for some time. But these two scenarios, as I mentioned, have direct new economic consequences.
How do these geopolitical shocks transmit to crypto markets?
Well, geopolitical shocks transmit to crypto through maybe three channels in this case. In these scenarios, you have, as I mentioned, oil prices, you have Asian-based capital flows, and you would have also a changed broader risk sentiment due to these two fairly large geopolitical developments. So this requires active risk management for those who have built certain investments already. So not some passive, let's say, safe haven positioning. Being passive in these scenarios, in these cases, would not be sufficient. Any geopolitical escalation typically triggers risk off in speculative assets, and at the moment, majority of crypto assets are speculative assets or risk-on assets. So when we look at Bitcoin's performance since Trump's inauguration mid-January, I mean, I think it perfectly reflects this reality that geopolitics also have influence on prices, Bitcoin prices or digital assets in general. I mean, Bitcoin is negative year to date currently.
There was also concerning data from China.
Yes, one major data point amongst some others is that China's latest PMI index readings are actually, the readings are showing a slowdown, I would say, in non-manufacturing activity, and this is the first time for almost 3 years. So some investors interpreted this as the region's growth engine is actually losing steam. It is slowing down. It is weakening. So combine that with the Japan situation that I've mentioned, both events could together would trigger risk-off positioning. It would negatively impact crypto markets, even though as I mentioned, US macro factors remain generally positive for digital assets.
Okay, let's talk about the good old traditional assets, gold and silver, which often have an inverse relationship
Yes.
with Bitcoin in the short term. What's happening there?
Silver has been rallying since last week. It printed new all-time highs. I think yesterday I've checked the prices was around 58. Gold is still holding strong. It had some retracements after reaching its all-time high. But it's slowly grinding back higher. So looking like it wants to retest its all-time high that was around 4,400 in October. So I have to say that this is usually not a good sign for Bitcoin in the interim, in the short term. So as a side note, regarding gold, Italy's prime minister, I think that was yesterday, Italy's prime minister, she seeks now to move control of the nation's 300 billion US dollars in gold reserves to move that control away from the European Central Bank, which is, I would say, another interesting geopolitical development since we are talking about gold prices.
And what about the US dollar?
The DXY, the US dollar index, showed some, I would say, good strength since end of September. Should Fed rate cuts in December materialize, I think it would undermine current DXY's strength, and it would actually help Bitcoin to rebound. For that, I would like to see DXY break below 99. I've been talking about this level for some time now. Otherwise, DXY above 100 would not bode well for Bitcoin or altcoins in general. This dollar dynamics remains critical because everything is denominated in United States dollars, and it moves in relation to the strength of or weakness of the United States dollar, which is represented by DXY index.
Okay, given everything we have discussed, the correction, early stabilization signals, macro uncertainty, geopolitical risks, what's your outlook into year end and early 2026?
I think we are in what I would call an early but very wonky stabilization phase. The market has begun to stabilize, but it's still very shaky, or the grounds for the stabilization are still very fragile. So I don't think it's enough to call a real bottom yet. The first clearest positive development is that Bitcoin and Ether ETFs show some positive flows and maintain those positive flows for a couple of weeks. The 115,000 range that I mentioned, I think that's the key zone. I'm watching for this shift in sentiment. And 95,000 is for me personally a first serious level, a first serious sign of a good chances to proceed higher.
Another important question. What are the key dates and data points investors should watch?
Well, currently in the short term, Fed rate cuts decision on the 10th of December next week. And of course, what happens with the Bank of Japan's decision, which is for 19th of December. I think those two are the most critical events in the short term. Given this data blackout due to US government shutdown, some key economic data is still missing. So alternative data is showing, as I mentioned, that US layoffs, US labor market strength is changing, or let's say these data points are important still. And I would also keep an eye on this China-Japan diplomatic tensions and this currently unfolding US situation with Venezuela. Everything is, all of those are likely facilitators for further either uncertainty for markets, including crypto, or perhaps some early stabilization, which would be very well well received from market participants, which would accelerate this shift in sentiment.
And are there longer-term trends that the market might be underpricing despite the current correction?
Longer-term trends, yes, I think so. I mean, one of those is maybe to rephrase. Some investors are still not fully accounting for how quickly economic activity in general is going to move on the chain, is going to shift on chain. You know, stuff like payments, tokenized investing, some social trading could accelerate actually or rapidly in 2026. The scale and speed of that, let's call it transition period, I think, and the demand that this could unlock, I think this would this still remains under appreciated. It's not really priced in. Not very. Only very few investors are looking in this or thinking in this direction, preparing for this scenario. So the fundamentals of blockchain adoption, in my view, have not changed. What has changed is macro and regulatory environment, and of course, leveraging the system. So rising adoption of new products and services that are actually built on blockchain technology is gaining traction, but I think it will be in a stealth mode. It will remain invisible, especially in combination with AI tools, meaning the people will not know that in the background it is actually blockchain that is a fundamental layer for this new product or service.
Igor, to be honest, what's your overall stance? Are you more bearish? Are you more neutral or optimistic from this point right now?
I I would characterize myself as a cautious bull going into 2026, but with much more maybe emphasis on risk management than we needed 1 or 2 years ago. There are many positive factors, just to repeat some of them: constructive U.S. crypto policy, Fed rate cuts that are coming, that are expected, even pro-crypto Fed chair possibility. And due to flash crash, there are some low valuations in some crypto assets that have multiples when it comes to, let's say, revenues on chain, long-term on-chain activity trends, which is in of itself very positive. So the negative factors, maybe also to mention a few, you have this geopolitical uncertainty that is a major, let's say, pain point or obstacle for many investors. We have Asian macro stress, breaking of this yen carry trade, which could trigger another sell-off in Bitcoin. And there's also need for the market to digest this October liquidation event, to regain trust, to rebuild. And all of it takes time. So I am a cautious bull into 2026. And I think that digital assets are not going anywhere. And the next year is going to bring out a lot of new products and services, and people will just use them without knowing, hey, it's blockchain in the background.
Any final points on positioning or strategy?
As I've mentioned, this current environment, I think it's more rewarding for being selective, being patient. So it is more of a, I would say, quality over broad exposure or quantity. So combine that with longer investment horizon, I think you are very well positioned to profit off of the current situation. The sell-off has reset valuations for fundamentally great projects, and Bitcoin dominance did not really sustainably increase during the correction. It did spike, but it was not something that remained for a long period of time, which tells me there is still no interest and appetite for quality altcoins, especially among smart and patient investors. But I have to also say that this current time is not really the time for speculation on low quality assets. So, focus on projects that have real usage, that have real traction, that have real revenue, real on-chain activity. And, critically to say, this simply requires to have active monitoring, active risk management, and that's just, spray and pray, buy and hold, and hope that the number will go up someday.
Yeah, thank you so much, Igor, for your time, for your excellent insights and the detailed analysis. Yeah, thank you for your attention. I hope you enjoyed our crypto insights, and we will back with new updates soon. And yeah,
Thank you for having me once again, and thank you guys for sticking with us for so long, and I hope to see you all back in 2026.